Okay, imagine completely rewiring your entire company to focus on selling one specific consumable product, only to immediately run out of the raw material you need to make it.
Yeah, the timing on that is objectively terrible.
Right. That is the awkward reality for Bionano Genomics today, ticker BNGO. It is March 23rd, 2026, and we are unpacking their Q4-25 print. Oh, and quick reminder, this is just our personal take, not financial advice, so please do not hold it against us if we butcher a complicated genomics term.
We will definitely butcher something. But looking at the release, the top line is... well, it is a bit of an optical illusion. Revenue came in at $8 million. That is up about 8.6% quarter over quarter, which sounds fine on the surface, except the actual physical volume, the flow cells they absolutely rely on to make money, that dropped 10%.
Which probably explains the absolute chaos in the tape today. I mean, they had this massive 28% run-up during regular trading hours. Then the bell rings, earnings drop, and the stock gets violently volatile before basically settling right back near where it closed the regular session.
The market is confused because the fundamentals are literally pulling in opposite directions. You have gross margins slipping down to 43% from 46% last quarter. They didn't even specify a hard EPS number in the release this time, though the net loss did narrow a bit to negative $7.9 million. But look, the only number that actually matters for their survival right now is operating expenses.
Actually, wait, they were flat, right? Roughly $11.9 million?
Exactly flat, which is the ultimate payoff of essentially gutting their own corporate structure. I mean, they slashed over 300 jobs and cut $100 million in annualized expenses over the last couple of years. It's brutal, but necessary. They're trying to operate a completely different business model now. They stopped pushing hardware box sales to every casual academic lab and shifted everything, literally their whole corporate strategy, onto extracting recurring revenue from high-volume routine users.
Right, just the power users. And for context on what they actually do, Bionano handles optical genome mapping, which is a way of looking at large DNA variations without using traditional sequencing. When they get one of those true power users, it completely changes the math, like that lab at Radboud University in the Netherlands. They essentially built an automated factory for this, hooking up multiple systems and scaling from 500 samples a year to 3,000.
That is the textbook dream scenario for them. That kind of industrialized throughput is where Bionano's margins actually survive. But the terrifying part is how rare that is. They have 387 machines out in the wild, but just 60 of those routine customers are driving 56% of their entire consumable revenue. It's an extreme barbell. A lot of those installed machines are functionally dormant compared to the heavy hitters. So if you're betting the company's survival on those 60 power users burning through your cartridges, a supply chain bottleneck is the very last thing you want to see.
Okay, yes, the silicon wafer shortage. Let's actually get into the details of that supply chain mess and also their runway because that clock is ticking really loudly.
Right, so the 10% drop in flow cells sold looks really awful on paper, but it is actually a bit misleading.
Because of the manufacturer delay.
Exactly. So late in Q4, their manufacturing partner for the silicon wafers just experienced delays. Bionano actually had the demand. The VP of accounting literally said supply was constrained against higher consumable demand. They just could not get the physical chips built to ship to these hungry labs.
That is excruciating. You pivot your entire corporate structure to a razor and blade model, and then your supplier forgets to send you the blades.
Well, I don't think they forgot them. But yeah, it is an unforced error. And the real risk here is not just delayed revenue. If you're a high throughput clinical lab and you suddenly can't get cartridges to run your daily workflow, you might actually rethink your reliance on the platform entirely. Reliability is everything in diagnostics.
Right, you cannot put a patient on hold because of a wafer shortage. So does this pent-up demand just automatically roll over into Q1, or do they lose those sales forever?
That is the big unknown. Management acts like it's just pushed into a backlog. But here's the thing, Susie. They can't afford any delays right now. They really cannot, because you mentioned the runway a second ago. The balance sheet is practically screaming.
They have $29.6 million in total liquidity, right? I think that was down from almost 32.
Down about 7%, yeah. And on the earnings call, management is out there saying they expect their cash runway to extend into 2027, which sounds incredibly comforting until you actually read the fine print in their Q3 filings from just a few months prior.
Oh, right. The going concern warning.
a massive going concern section because in May 2026, they have a senior secured convertible debt maturity staring them right in the face. It is around $10 million. You cannot project safety into 2027 if you have not explicitly addressed how you are paying the landlord in May 2026.
So let me make sure I'm getting this. They are essentially racing to prove the power user model works and that it generates enough cash before that debt comes due. That totally explains the brutal cost cutting. But if supply chain issues push revenue out even by a single quarter, that margin for error just completely evaporates.
Bingo. The margin for error is basically zero. But, and this is important, they did get one massive piece of good news on the pricing side. This is huge for the power users. The U.S. Medicare fee schedule, the CLFS, just bumped up the reimbursement rate for optical genome mapping in blood cancers, up by 47% for 2026.
Wow, 47% is massive. So a lab goes from making, roughly $1,200 a test to almost $1,900?
Up, actually a bit over $1,800, $1,853 now. And the CEO was extremely clear about this. He said, and I'm quoting here, "We expect this higher price to even accelerate adoption and utilization more. That is a major catalyst. It fundamentally changes the economics of adopting a Bionano system versus standard long-read sequencing."
Which they desperately need, especially considering they only placed 9 new systems this quarter. It sounds like they're betting the farm that labs will see that new reimbursement rate, ignore the supply chain hiccups, and just run these existing machines into the ground to print money.
That is the bet. They are essentially a consumable and software company now. Actually, speaking of software, that was another very weird data point. Software revenue tanked 22% this quarter.
I completely missed that part. If software is recurring revenue, how does it drop 20% in 3 months?
It was basically an accounting quirk. The CEO mentioned a handful of orders got pulled forward into previous quarters, so Q4 looks like a massive drop, but it's really just lumpy ordering. But it highlights how fragile their base is. I mean, if a handful of orders can swing an entire segment by 20%, your customer pool is terrifyingly shallow.
So everything circles back to concentration risk. A tiny pool of buyers, a tiny margin of error on debt, and one giant regulatory price bump to try and save the day. So where does this actually leave them heading into the guidance for next quarter?
Well, it leaves them bracing for a bit of a slow start. They guided Q1 revenue down to about 6.5 to 6.7 million.
Wait, down from 8 million this quarter? That is a huge step back.
It is, yeah. But the CEO essentially said it is normal seasonality, and they expect revenues to grow throughout the year. They are officially initiating full-year guidance at 30 to 33 million, which represents roughly 5 to 16% growth over 2025.
Okay, so it really looks like they are betting the entire year on back half execution. It is kind of a high wire act. They built this highly profitable setup for a very specific type of lab, but they just need more of those power users to actually outrun that debt clock.
Exactly. The real tell next quarter is not going to be just top-line growth. It is cash burn. Because if they clear that wafer backlog and if labs start hammering those consumables with the new price bump, I mean, this dramatically lean cost structure could actually print cash. They prove they can cut the fat. Now they just have to prove the underlying engine works.
It is honestly a fascinating shift. You strip away the typical biotech growth hype, and you're left with just a brutal, hyper-focused survival story. If they pull this off, it's a masterclass in restructuring. If not, well, May 2026 is going to be incredibly painful.
Very painful. But I will say they are not in denial. They took the medicine with those massive layoffs. You really have to respect the discipline.
Absolutely. Credit where credit is due. I think that's a solid place to wrap this one up. We'll see if the power user gamble pays off next quarter.
Right. Watch the backlog. Watch the cash. Catch you next time, Susie.
Bye, Miro. And hey, if you want these little earnings breakdowns to just show up in your feed, you might want to follow the podcast. We actually put this show together with a bit of AI assistance, really just to see how well machines can help us untangle all this market noise. So if there is a ticker you want us to cover or you just have some feedback, email us at earningsunscripted@datamagus.ca or grab that X link in the show notes.
Thanks for listening, everybody.